Hello everyone, this is Alia Sayed from the Money Works For Me team. We all know that the stock market is a highly volatile place where many of us have lost a lot of money. So Money Works For Me has come up with 9 simple steps that will help you invest your money safely yet ensure great returns. I have a few instructions before we begin the webinar. The webinar will be followed by a Q&A session. You can ask your questions through the chat window present on the right hand corner of your screen. If you all have any queries or feedback for us, please mail it us to customercare@moneyworksforme.com. I now hand it over to Nikhil Kale, Team Leader Research and Customer Education, to take you through the 9 secrets.
Thank you, Alia. I hope the voice is clearly audible now. So today's webinar is on secrets of safest stock investing unveiled. Before we get into these 9 secrets, quickly let's understand what will we learn by the end of this webinar. As Alia mentioned, we'll be covering 9 secrets of safe stock investing, and beyond that we'll also be taking you through some features on our site moneyworksforme.com, which will help you understand how you can follow these 9 secrets of safe stock investing. Okay, so we'll tell you how moneyworksforme.com can help you do this at the click of a mouse. Okay, to quickly give you a background on why safe stock investing is important right now. We are seeing a lot of issues currently in the stock markets. Okay, be it the European crisis that has been impacting the global stock markets, or be it the domestic problems that we are facing, such as high inflation, low GDP growth rates, policy paralysis on the part of the government, lot of uncertainties and lot of volatility, which can greatly hamper your returns from stock investments, right? So in such times, what is important is to ensure that A, your capital does not get eroded, and B, that you get good returns, right, to compensate for the risk, for the inherent risk that you take when you invest in stocks, right? And what we are saying is, instead of focusing on any stock that you can hear of, we need to focus on safe stocks, okay, because they will help, they will ensure that your capital is protected and can also give you good returns. Okay, so what are these 9 secrets which you should follow to ensure that you invest in safe stocks? Well, first is to invest in a business you understand. Okay, quite simple, quite commonsensical. Reason being, because it is our hard-earned money that is at stake. Okay, and the problem is that many of us will research for a lot of time, even if we are, say, buying a mobile or even for a small purchase. But when it comes to investing our hard-earned money, not only in stocks but in any other financial instrument, our research goes for a toss, right? We just tend to listen to what others are saying, listen to some advice given by any person or by the professionals themselves who might be biased, right? So it is very important to understand in the business, the kind of business that you wish to invest in. Another reason being that you will study and follow them more easily going forward. Okay, and one thing that you need to be very clear of, that no matter what anyone will say, investing in stocks does involve a little bit of study and a little bit of sort of follow up, right? You cannot just say that, okay, I'm just investing based on someone's advice and not look at it after some time, right? You need to be tracking it, you need to be on top of things at like on a frequent basis. So if you invest in something that you understand, there is a greater likelihood that you will study and follow these companies more easily. Okay, lastly, what will also happen is, if you understand a particular business, you will be able to recognize if a company is actually a good or a bad investment. Okay, so for example, suppose you are working in a bank, or say you are working in an IT company, right? It is definitely going to be more easy for you to understand which IT company or which bank is doing well, will continue to do well in the future based on its business, right? And that's where you'll be able to recognize whether a company is actually a good or a bad investment, right? So therefore, very important that you invest in a business that you understand. So that's our secret number 1. Secret number 2 is stick with large caps predominantly, avoid penny stocks, right? Why? Because large caps, okay, these are the largest companies in the market based on market capitalization. These companies are relatively safe and established players. Okay, compared to this, small caps are very risky and offer less liquidity. And a very good analogy that I can give you here is, think of large caps as being a heavy goods carrier. Okay, so a heavy goods carrier will take some time to pick up speed, but once it picks up speed, it has a very high momentum, right? It will continue to travel at a constant speed, and if there is a small bump in the road, if there is a small pothole, it won't affect the heavy goods carrier much, right? It will continue to move in its journey, right? Whereas think of a racing car, right? Like a two-seater racing car, which can pick up speed very quickly. Okay, it can go from 0 to 100 in like 10 seconds. But if there is a pothole, there is a small bump in the road, higher chances that the car can get toppled. Okay, so large caps are like your heavy goods carrier. Okay, safe, established players, good, consistent performance. Whereas small caps are can get you great returns, but also very high chance that they might just go bankrupt, and then you will lose your entire capital. And because we want to ensure that a capital does not get eroded, it is a very good idea to focus largely on large caps, and you can go to mid caps to a certain extent. Small caps don't. If you're a investor who is just learning to invest in stocks, or who is a risk averse investor, avoid small caps, and especially penny stocks. Okay, and that is, I think, the flavor of the market. Everyone wants the next big multi-bagger stock idea, and then we tend to invest in all such penny stocks, okay, which we feel will become the next multi-baggers. But avoid these penny stocks, because they by investing in such stocks, there are more chances that you lose your entire investment. Okay, so that's secret number 2. Secret number 3 is look for companies with a moat. What is moat? Well, this term was coined by I think Warren Buffett himself. Moat is what you are seeing in this image. Okay, you see the image of a castle, and there is this water body around the castle. The function of this water body was to prevent the castle from being attacked by enemies. So if the enemy attacked the castle, they would find it quite difficult to sort of cross this water body and then take over the castle. So similarly, in today's world, we are looking at businesses which have something special, some sort of a moat or a sustainable competitive advantage, which makes it difficult for other companies to sort of enter the industry and to steal away their profits. Okay, so this kind of a moat will also help a company earn superior returns. To give you examples of moat, I think the last line gives you those examples. Something like a strong brand. Okay, so think Colgate, right? A very, very strong brand. Almost all of us know about Colgate. Now, making toothpaste is not a very difficult task. I can just, if I have enough money, I can just start a toothpaste manufacturing facility. Maybe I can manufacture a better quality toothpaste as compared to Colgate as well, right? But will I be able to sell it to the extent that Colgate sells its toothpaste? I don't think so, right? Why? Because Colgate has created such a strong brand that it is very difficult to compete with Colgate based on its advertisements, expenditure and everything, and trying to grab a market share that Colgate has earned over the years, right? So Colgate is a very good example of a strong brand. Other examples of moats are patents, switching costs, or say high capital investment. So aviation is a good example, wherein a very high capital investments are required to enter the business. So not everyone can enter this kind of a business, right? So these kinds of modes can help a company earn superior returns. So think of, say, branded clothes. Okay, so Levi's jeans. Many of us might have bought Levi's jeans. Now, even though Levi's jeans might be expensive than, say, some local brands, we still tend to go and buy a branded pair of jeans. Reason being, though it is expensive, the value, we ascertain the sort of extra cost to the value of the brand. So this brand value helps Levi's to earn superior returns, right? Its margins will be much higher than some local brand. So that is how a moat can help a company earn superior returns, and it can also help a company maintain and grow its profits even in tough times. Okay, so that's why we are looking for a moat or a sustainable competitive advantage. Secret number 4: do not invest in companies having erratic financials, right? Now, why? Because these companies are most likely to fall apart during bad times. Okay, quite understandable. I mean, if we are investing in a company, we want the company to be earning good profits. Okay, another analogy, if I had to give you, if you were to pick players, okay, cricket players for a team, Okay, if I told you that you have a team that you can play in, that you can field in the next year's IPL, and if you had to play, or if you had to pick players for your team, which players would you look at? You would look at all the best players, right? You would look at Sachin Tendulkar, Mahendra Singh Dhoni, Chris Gayle, right? So all these good players you will look at. Reason being, they have a proven track record, right? They have a history of performing well, of doing well, of being consistent, and that's why we are more assured that they will continue to do well in the future as well, right? So a track record gives you that assurance, and that's why we want to invest in companies which have this excellent financial track record, which have done well in the past as well. Okay, because there is no guarantee that the company will keep reaping profits year after year if a company has erratic financials, right? So if a company has done well in the past, you can be quite sure that it will continue to do well unless there is some big change in its business. Okay, so erratic companies with erratic financials will most likely fall apart during bad times, and they won't give you the guarantee that they will keep reaping profits year after year. Okay, but what is the problem that we face? Financial statements are too complicated. I mean, it's not everybody's cup of tea. It's rows and rows of data, numbers, and it just can drive you crazy if you start trying to understand them. Okay, so what we are saying is you don't need to look at each and every financial parameter. Okay, you don't need to study each and every line item given in the profit and loss statement or the balance sheet. Okay, what you need to do is look at the most critical parameters. Okay, and we have some sort of critical parameters that we have shortlisted for you guys, and these are a net sales. Okay, so I'm looking at if the company is selling its products and increasing its sales year on year. So I'm looking at net sales, so that is telling me what is the demand for the company's products. I'm looking at EPS or profit, which is basically telling me if the company is profitable, right? Very important thing to look at. I'm looking at CFO, which is cash flow from operations. So making profits is not the only thing. The company also needs to generate cash from its day-to-day operations. So that is why I'm looking at cash flow from operations. Once the company earns profits, it can choose to give it to us as dividends, or it can choose to reinvest the money in itself, right? So as to cater to increasing demand, it will want to increase its capacity, right? So it needs to reinvest money in the business, and that is what we are looking at when we check the BVPS, or book value per share. Okay, so how much money is the company reinvesting in itself? Okay, another parameter that we look at is return on invested capital, right, which is basically telling me the efficiency of the management at utilizing the funds. Okay, so these are some critical parameters that we can look at. Later on I will tell you a very unique tool that we have at Moneyworks for Me, which basically helps you analyze these critical parameters in just one glance. Okay, so we'll talk about that later. Secret number 5: avoid companies with high debt. Okay, again, very simple but often overlooked. Okay, and again, this can I mean, you can relate with this secret in your daily life as well. I mean, would you like to give your hard-earned money to a person who is who has a lot of debt on his head? No, right? I mean, if you had two friends who were asking you for money, and if one of them had a lot of owed a lot of money to quite a few people, you would be very circumspect in giving him money, right? So similarly, when you're investing in stocks, look to invest in companies which are debt free. Reason being, they are financially much healthier, and I think that will be reflected in the financial track record as well. Companies which tend to do well over a long term will invariably be companies which have sort of controlled their debt, okay, very well. Okay, they haven't gone overboard in terms of borrowing money. So these companies will be financially much healthier. And also what happens is, if you do not have a lot of debt on your books, you can basically have cash, a lot of surplus cash. If you are profitable, you can generate a lot of surplus cash, which you can keep on reinvesting in the business, and which you can further invest in various growth opportunities. Okay, so whenever there is some acquisition, there is some very attractive opportunity that comes up, companies which do not have debt, which have surplus cash, can make or take the advantage of this opportunity. Whereas if you compare this to a firm which is burdened with debt, these companies will face tough times when the economy turns sour. Okay, very good example that we have in front of ourselves is Kingfisher Airlines. right? Almost on the verge of going bankrupt in the current scenario. The company doesn't even have cash to run its daily operations, right? So basically, as I said, debt can make the company bankrupt, and we want to avoid such companies. Okay, and the case that we see with Kingfisher is what has happened is the interest rates stayed at a very high level over a period of time, because of which the cost of borrowing fund also increases, right? And then servicing the debt becomes increasingly expensive, and it starts eating into the company's profits. Okay, and in fact, Kingfisher Airlines, if you see, it has been loss making for quite a period of time, right? Time till now. Okay, so avoid companies with high debt. Secret number 6: look for a trustworthy management. Okay, and this is where we say that you should always bet on the jockey, right, and not on the horse. So very important parameter, but also a very difficult thing to assess. Reason being, it's a very subjective thing, right? I might feel that the management of a company is very good, whereas you might tend to think that it is the most corrupt management ever, right? So very subjective thing, and especially with cases such as Satyam, which we have had in the past, it is quite difficult. I mean, till the Satyam fiasco came out, nobody had even a clue that there was something wrong with the company. Okay, it's only when the entire thing came out that investors or even analysts all over the world became aware of these problems, right? So quite difficult to assess, but that doesn't mean you should overlook this parameter or this trait completely, right? So what can you look at when you are trying to assess management? And that is something we have been trying to do at MoneyWorks4Me. So basically, we have tried to come up with a model for assessing the management, where we are looking at a few important parameters. Okay, and so what are these parameters? We are looking at competence. Okay, so over the years, has the management been able to grow the company at a good consistent rate? Okay, whether it has been able to fulfill the plans that it has laid out in the annual reports. Okay, something like that. Transparency, so how transparent are the management in communicating its expectations for the future growth plans, or even if it did something wrong. Okay, if it did not, the company did not do well, is the management transparent enough to accept that there was some problem, there was something wrong, and what are the steps that they are taking to right this wrong? Okay, honesty, again, similar to transparency, whatever we have talked about. And then lastly, shareholding and pledging of shares. Okay, and the first three parameters that I mentioned are quite qualitative in nature. So shareholding and pledging is important because it is one of the few quantitative parameters that you can look at. Okay, so what we are saying is the promoters that you have. Okay, so the promoters should have a good consistent shareholding. It should not happen that they are the ones who are selling their shares over the last few quarters, and we are the idiots who are buying into the company, right? And we are also looking at pledging of shares, because we have had quite a lot of companies which have the stock prices of these companies have gone down the drain because the promoters pledged a very high portion of their holding. Okay, to quickly explain to you what pledging means is basically you have promoters of a company who have, say, borrowed money, okay, due to whatever reason, because they want to build a 50 crore house, right? So they have borrowed money, and as collateral for this borrowing, what they have done is they have pledged their shareholding in the company. Okay, so whatever shares that they hold, they have given that as collateral to the financial institution from which they have borrowed the money. Now what happens is, if say the company has a bad quarter, okay, something happens and the quarterly results are not very good, and the share price starts falling, okay, because of a bad performance in a particular quarter, what happens is these financial institutions, the value of their collateral also starts decreasing, okay, as the price of the share starts falling. So they'll ask for more collateral from the promoter. If he does not have the collateral, okay, if he does not have more money to top up the collateral, the financial institutions will start selling the shares in the open market. Okay, and that is when the problem starts, because what happens is the price is already falling, and when there is an oversupply of shares in the market because the financial institution is selling, the price starts to drop like a rock. Okay, and before we know it, and before we can even understand what's happening, you'll see that the stock will be in a circuit and you will be sitting on a huge loss. Okay, so that's why it's very important to avoid companies where shares have been pledged by promoters, and the pledging has been very high. Okay, good. I mean, top of my mind, the examples that I can remember are, say, something like GTL. You had Billcare. Another pharma company there was of Ankur Drugs. So quite a few companies wherein the pledging was quite high and where investors suffered. Secret number 7 is look for a margin of safety. To explain to you in very simple terms what is a margin of safety, it is kind of a discount. Okay, now think of it this: when we go for shopping, okay, say when we go for shopping, clothes, okay, I want to buy clothes. When do we tend to go for shopping, right? uh, Most likely it will be when a sale is on. Okay, and currently I think in the monsoon season you will have lots of uh, shops which are offering heavy discounts. So that is the time when we go to shop for clothes. So what we are looking at is always a discount. So what we are saying is, when it comes to stocks, you should also demand a margin of safety or a discount. Okay, so you might think there is no MRP for stocks, but what we are saying is, suppose if you had a MRP for a stock, okay, and that is what we have done at Moneyworks.me, wherein we have calculated the MRP of stock. So if you have the MRP of a stock, what you should do is you should always look for a margin of safety, and that is again a concept which has been propagated by, say, Benjamin Graham and Warren Buffett. Reason being, this margin of safety or this discount will help to minimize your risk and to protect your capital. Okay, so if you know that the MRP or the real value, real worth of a stock is say rupees 650 as the image shows, and suppose you want a margin of safety of say 50%, you should buy the stock at rupees 325. Okay, why? Because the stock is being so undervalued that the probability that it will go further down is very less, so your capital is protected. Okay, and further it will help you make bumper returns, because as Benjamin Graham said, in the short term the market acts like a voting machine, and in the long term the stock market will act as a weighing machine. So sooner or later the market does realize that this stock is undervalued, and then the price corrects, and when this happens you can make great returns. Okay, you can earn bumper returns. So that's why you should look for a margin of safety. Secret number 8 is diversify, but do not over diversify, and that is something I think many of us fail to do. Take an example, say 2 years back, it was say 2009, the market had just recovered from the crash that we saw after the subprime crisis, and you went and bought 2-3 telecom stocks. Okay, you bought Bharti Airtel, you bought Idea, you bought Reliance Communication. Now would you be sitting on profits right now? Most probably not, right? Why? Because the sector as a whole got into a lot of trouble. Okay, there was high competition, heavy competition in fact, which led to a price war, and then there were regulatory issues, then there was the 2G scam that came out. Okay, then licensing happened, so the companies had to bear a lot of costs. So all these problems hampered the entire industry as a whole, and all the companies, okay, even if say Bharti Airtel was performing better than say the other companies, it still suffered, right? So even the best of players will suffer if a particular industry is impacted by certain problems. That's why it is important to ensure that you have a mix of companies from different sectors. Okay, because it will reduce your risk. Okay, but obviously diversification can only reduce it to a certain extent, right? So that's why it is very important to follow the other secrets as well. Okay, to decrease your risk considerably. Further, as I mentioned, it will protect your investment from downfall in any one stock, sector or industry. Okay, so you should also not just focus on one stock. So I cannot just go ahead and invest my entire portfolio in Bharti Airtel or say the telecom industry, right? So it is important to have a mix of stocks, have suppose say around 8 to 10 stocks in your portfolio. Also, on the other hand, it is important to not over diversify, right? So the other thing that people do is they'll go ahead and buy 50 stocks, okay, all from different sectors, and then what you'll notice is your returns are nothing. I mean, your returns are very low as compared to even say the broader Sensex or the Nifty index, right? So it's a quite a delicate balance, but something that we need to do, which is diversify but not also over diversify. And lastly, the secret number 9 is always use a stop loss. Okay, stop loss is basically a term which we are taking from sort of technical analysis or say even day trading. In day trading you usually have stop loss, the concept of a stop loss. But what we are saying is you can use this concept even in fundamental investing or from a long-term investing perspective, right? Why? Because you want to limit your losses. What is the stop loss? Suppose the stock is trading at rupees, say rupees 50, okay, and I want a stop loss of say 10%. So what I will say is, if the stock falls below rupees 45, okay, I will sell off my holding. Reason being, there might be something which I might have overlooked, okay, there might be some news, something that the market knows and I don't know, and that's why I'll get out of the stock and then reanalyze my analysis, okay, review my analysis, okay. So if everything is right and this is just a market overreaction, I'll then again enter it at the lower level, okay. So that is why a stop loss is important, because it will limit your losses. Further, you can extend this concept by having a trailing stop loss, okay. What is a trailing stop loss? If the stock price falls, your stop loss doesn't change. However, if the stock price starts rising, your stop loss also starts increasing. I'll later on show you a graph, so don't get confused if you didn't understand what I was saying. But what we are saying is, your stop loss should increase if your stock price also starts increasing, okay. So what you will eventually end up doing is, you will also sort of protect your profits, okay. And I think once I take you through the graph and explain the concept properly, you will understand it very easily. So just keep in mind that stop loss will help you limit your losses as well as protect your profits, okay. Further, it will also help you, because you won't have to monitor your investments daily. What you just have to do is put up the stop loss, okay, and then not keep on tracking it every day. Whenever that stop loss is sort of triggered or is arrived at, you will get an email in your mailbox stating that your stop loss has been reached, okay. So let's quickly see how a trailing stop loss can help you. Okay, so this is the price of ONGC in 2011. Now consider this price, okay. The stock is somewhere around 250, okay. Now what if you feel, suppose that this was a very attractive buy price and you decided to buy the stock at this price, okay. So my buy price was around 250 and I kept a stop loss of 10%, okay. So 250 10% works out to close to 2, so it works out to 225. So what the trailing stop loss, how it works is, if the stock price starts falling, okay, if the stock price goes in this direction, okay, and if it crosses 225, I will sell off my holding, okay. I'll just book a loss of say 25 rupees per stock and I'll be okay with that. Reason being, there might be something I might have overlooked, okay. However, if the stock price rises, which has happened in this case, my trailing stop loss won't stay at 225, okay. It will start increasing, okay. So it will go something like this. I'll keep the 10% margin similar, okay. So it will also start increasing, okay. And if the stock price falls, it will stay at the same place, okay. So it will be like this, then it will again start increasing. Here the stock price is falling, so it will stay constant, okay, and then again increase and then again stay constant, okay. So if the stock price starts falling, my my stop loss doesn't go down. If it starts going up, my stop loss goes up for sure, okay. So consider this situation. The stock price reached close to 360, okay, say 350. If you had a stop loss of 10%, your stop loss would have been 350 minus 35, okay. That works out to 315. Now what you will do is, if this 10% stop loss is sort of crossed, which has happened, if it was 315, my stop loss would have been around this level, okay. If this stop loss is triggered, you will sell off your holding, okay. So what I'm what I'm doing is, I am sort of protecting my profit from this level to this level, okay. I'm not letting go of that profit, because I felt that this is just a sort of a downtrend and the stock will reverse again, okay. And I can then enter the stock again at this level or this level, whatever level I feel is attractive enough for me, okay. So that is basically how the stop loss will help me limit my losses as well as book my protect my profits, okay. Now to summarize, let's quickly summarize the 9 secrets that we have, which is basically number 1, invest in a business you understand, stick with large caps predominantly and avoid penny stocks. Secret number 3, look for companies with a moat. Secret number 4, do not invest in companies having erratic financials. Okay, quite easy to understand. If you have not understood any of these, please post in the chat message and we'll take it up after the presentation. Secret number 5, avoid companies with high debt. Number 6, look for a trustworthy management, especially look at the shareholding and the pledging. Secret number 7 is look for a margin of safety. Number 8 is diversify but do not over diversify, and lastly always use a stop loss. Okay, so 9 very important and very easy to understand secrets. So we understood the secrets, but the final trick is to know how to follow these secrets, right? So now what we'll do is we'll tell you how moneyworksforme.com can help you do this. Okay, help you follow these 9 secrets at the click of a mouse. Okay, before we get into these unique tools, there is a short poll that we want to just run for you. We just want to know if you are a registered or a subscriber, registered user or a subscriber of a site. So I think you can see a poll on your screen right now. So I request you to start voting. Are you a registered user or a subscriber, just to help us get an idea of the audience? Okay, thanks for your voting. I think we have got a very good response. So we'll be closing the poll now. Okay, so let's now look at what are the unique tools that we have that can help you invest in safe stocks. Okay, and we have two very unique tools and a very useful product that we have recently launched. Okay, and these are the first three things that I'll be talking about. These three tools are basically these two tools are basically the Moneyworks for Me filter and the decision maker, and a unique product that we have recently launched is the Nifty 50 Superstars. Other than that, we also have some other unique tools such as the 10-year X-ray, management X-ray, company pulse report, price calculator, portfolio managers, etc. But I'll come to them in due course of time. Let's quickly check out these unique tools, which is Moneyworks for Me filter. So this is our website, Moneyworks for Me. I hope you are seeing the website on your screen. Okay, so I'll just log in as a paid user and take you through these features. Okay, so here are the two unique features that I talked about, which is Moneyworks filter and the decision maker. Okay, now two ways that you can start investing in stocks, right? If you have a stock in mind, okay, if there is some stock that you already have in your portfolio or somebody has told you about, okay, you can check that stock with the decision maker. Okay, and I'll tell you what this tool does. Or if you are not very sure about how to go about finding the best stocks and you want to find out which are the best stocks available in the market right now, you can start with the Moneyworks for Me filter. Okay, so what I'll do is I'll start with the Moneyworks for Me filter for now. Okay, which helps you find out the best stocks. Okay, the best stocks to invest in just the click of a mouse, at just the click of a mouse. Okay, three very simple steps. All you have to do is sort of set up your criteria. Okay, so first step that I have to choose is choose all companies, or if I want to invest in a particular sector, okay, or I can choose even indices, right? So this will basically sort of create the universe within which I am filtering companies. So what I'll do is I'll keep all companies for the time being. Next, I want to pick companies by fundamental strength. So I told you that we want to invest in companies which have strong financial track record. Okay, at Moneyworks for Me, what we have done is we have color coded companies. Okay, we have color coded companies based on their financial performance. So if a company has performed very well over the past, we have color coded them as green or very good. If they have done quite well, there have been a few good years and a few bad years, we have color coded them as orange or somewhat good. If they have not done good at all, okay, the performance has been very poor, the companies have not done well in the past, we have rated them as red or not good. Okay, so here we want to stick with green companies as it was given in our secrets, 9 secrets. And then the last step is to select a margin of safety. Okay, the discount that we are looking for. So I told you that at Moneyworks for Me, what we have done is we have calculated the MRP or the right value for each stock, and what this step allows you to do is to choose the margin of safety that you are comfortable with. Okay, so I can say 25 to 50% discount below MRP sounds like a good sort of starting point. Okay, so all I'll do now is just click search. Okay, and there I have it, right? 22 companies. Okay, and I think many of us struggle to do this, which is find the best companies to invest in, and the Moneyworks filter can do that for you in just within seconds, right? So as you saw, I just like put up a few criteria, and within seconds I have 22 quite attractive or quite investment worthy companies in front of me. Okay, all I have to do now is to check them further. Okay, so this list is in front of you. What I'll do is I'll go ahead and check Infosys. Okay, so this will lead me to the decision maker. Okay, and you can also go to the decision maker from the first step that I showed you. Okay, if you had any stock in mind, you can just put in its name and check the decision maker. The decision maker basically helps you get the answers for the 3 most important questions that you need to ask yourself when you are buying into stocks. Okay, so whenever you are buying into stocks, okay, you need to ask yourself these 3 questions. Okay, A, is it the right stock? B, is it the right price? Is it available at the right price? And C, is it the right time to buy this stock? Okay, I'll take you through one by one these questions. Okay, so in the right stock, what we are looking at is a good financial performance in the past. So what we have done is we have looked at the 10-year financial performance of companies through our tool, which is called 10-year X-Ray Pro, and then color coded them as green, orange or red, which is very good, somewhat good or not good. And we have also rated the long-term future prospects. Okay, so how the companies, according to our based on our assessment, how the companies will perform in the future. Okay, that is what we have rated. So here, if both these color codes are green, that means it is the right stock. Okay, so ideally we want both these color codes to be green. You can also look at orange companies. Okay, 1 green plus orange or 2 orange if you have high risk taking capacity. But remember, you need to avoid red companies. Okay, so at all cost avoid red companies. Okay, so if both these are green, it is the right stock. Second step, is it available at the right price? So here what we are doing is we are showing you where the current market price of the company is in relation to the MRP and the discount price through a very easy to understand slider. Now what is MRP? MRP, I told you, is the right value of the stock based on fundamentals. Okay, so what we have done is we have assessed the company's earnings capacity, how it will do in the future, and arrived at a estimate of its actual worth. Okay, and based on the margin of safety, okay, so what is the discount that I am comfortable with for Infosys, I have arrived at the discount price. So if you consider this margin of safety of 25%, the discount price works out to 2600. Okay, now if the current market price is below the discount price, it is in the buy zone. If it is somewhere in this orange part, it is in the hold zone, and if it is in the red or the above the MRP, it is in the sell zone. Okay, so if the stock is in the buy zone, it is available at the right price. So for Infosys, we know it is the right stock, it is the right price, but is it the right time to buy this stock? Okay, now how is timing different from price? Okay, well, what you see in the market, and I think this is something I personally have gone through, is many times it happens that you find a very good or an attractive stock, okay, in which you want to invest in, but what happens is the price is right, the stock is right, you invest in the stock and the stock price starts falling further. Okay, so if you invested in at say 100 rupees, the stock goes down to 90, it goes down to 80, and slowly your blood pressure starts rising, right? I mean, you knew it was a very good buy at rupees 100, but somehow when it goes to rupees 80, it doesn't seem so good, right? And that is basically your fear starting to kick in, right? Because you are sitting on a loss of 20 rupees. You get scared. Okay, it is difficult to follow the investing discipline. Okay, I might have told myself, no, I'm right, my analysis is correct, and I need to invest more if the price falls. But if the price starts falling, I find it difficult to adhere to that discipline. So what we are saying is momentum also plays a very important role. Okay, so it's not only about fundamentals, you also need to see where the market is headed. If the entire market is going down, chances are that you will get the stock at a much lower price. So that's why it becomes important to combine fundamentals as well as technicals, and that is what we have done through the timing portion. Okay, so what we have done is we have looked at some critical technical indicators, and based on those indicators, if the stock is in the buy zone, whenever the technical indicators signal, will give you a buy, strong buy or a consider buy signal. Okay, so based on technical indicators you are getting these buy signals. Okay, if I had to check the timing chart, okay, so this is the timing signal which has been generated for Infosys. So around 2425. Okay, so 2425, that was the price when the timing signal was generated. So this is a consider buy signal that has been generated for Infosys just few days back. Okay, so this timing signal will basically help you catch the stock when it is not going down, but when it is starting to move up. Okay, we don't want to get in when the stock is going to fall further. We want to get in when the stock most likely will start rising from this point onwards, right? So these technical indicators will basically signal you when is the right time to enter the stock. Okay, so that is how we have basically combined fundamentals as well as technicals, right? So just 3 steps and you get a instant decision on what you should go and do, right? If it is the right stock, it is available at the right price, and it is the right time, go ahead and buy the stock. So similarly, you will also get sell signals. So it is not only about buying, you also need to sell your stocks to earn profits. So similarly, if the stock price is above the MRP, the technical indicators will give you a sell or a strong sell signal. Okay, so that is what the decision maker does. It gives you very easy to understand input, so you can take a sensible decision. You can put in any company name and check it out further. Okay, so if I want to check out Reliance Industries, just put Reliance, take Reliance Industries, and I can get its decision maker. Okay, so for Reliance, it is currently in the hold zone, and rightly the timing signal is telling you to wait. Okay, and what's more is, it's not just random, or it's not just color codes that we have given you, right? There is a robust in-depth framework supporting these inputs, okay, or these outputs for you. Okay, so what you can do is, if you want to check out the 10-year X-ray more, just click on it and it will lead you to the 10-year X-ray of this company. So here you will see the 5 parameters that we talked about. Okay, in the presentation I talked about some of the critical financial parameters that you need to look into. What we have done is we have color coded them. Okay, so it's just like a one glance and you can arrive at a conclusion, right? Anytime this is much easier than, say, checking out the entire financial statement, right? So here you can see the MoneyWorks for Me color coding is orange. Okay, so just one glance and you get to know how the financial performance has been. You can also look at the management X-ray. So here, as you can see, we have given the management X-ray for Reliance. We have basically given it only for the Nifty 50 companies till now, right? It takes a lot of time to basically analyze the management. So currently it is restricted only to the Nifty 50 companies, but as you can see, promoter shareholding, pledging, 0% pledging, so that's a good sign. So as I said, it's supported by in-depth research. We have a company pulse, which is basically a very easy to understand company report. So it will help you to follow the secret that I mentioned right at the start, which is understand the business before you invest in it. So it will give you all the details and all the future growth drivers for the company in very easy to understand language, in a visually rich format. So it is interesting for you to as well to read it and to understand the company further. Okay, so this is about company pulse. We have a price calculator where we have arrived at the MRP. So as you can see, we have used certain parameters to calculate the MRP of the stock. What you can do is you can feed in your own estimates. Okay, so if you feel that the company will grow at, say, lower than 14%, if you feel it will grow at 12%, okay, you can calculate your own MRP, right? So this is lower than the MRP which has been calculated by MoneyWorks for Me. So this basically helps you to practice whatever understanding that you have generated and come up with your own estimate of the right value or the MRP for a company. Okay, so this is what all these features are. So quite a lot of unique features that we have. We also have portfolio managers. So in Botlist, what you can do is you can enter your stocks and it will help you to adhere to the secret that we mentioned about portfolio diversification, right? So we said you should diversify your portfolio, but at the same time ensure that you are not over diversified, right? So here you can see we have a very easy to understand or a portfolio quality graph which tells you what percentage of your portfolio is invested in green or very good companies, okay, as far as financial strength is concerned. So here I can see a large part is green followed by orange. So if a large part of your portfolio is red, you should be worried, right? You should be investing in more in green companies. I can take a sector wise view of my portfolio. Okay, so I look to be quite diversified into a number of sectors, right? So my portfolio seems to be quite well diversified. I can also look at company allocation graph. You can look at sector allocation. So as you can see, I have almost 6 to 7 sectors in my portfolio, which is a good sign, right? The portfolio seems to be quite well diversified, right? So these are some of the unique features. I'll quickly talk to you about a new product, and I think a very useful product that we have launched recently, which is the Nifty 50 product. Now we talked about 9 secrets, okay, but following them on your own is still quite a task, right? I mean, you'll have to find companies where the debt is less, which have performed well, which have a moat, right? But what the Nifty 50 Superstars does, right? It gives you a ready-made list of such safe companies, right? We talked about safe stock investing. Now Nifty 50, which is an index of 50 of the top companies in the country, is a list of such ready-made safe stocks, right? I mean, these are some of the biggest stocks, and they have something which has enabled them to become so big, right? So this is like a ready-made list of 50 companies that we have in front of us, and what the Nifty 50 Superstars does is it helps you to track these 50 companies in one place. Okay, so it reduces your burden or reduces your work quite a lot. See, all these Nifty companies are large cap companies. Most of them have performed very well in the past. Because they have performed so well in the past, most likely they have a competitive advantage or a moat. So somehow these, in a way, these companies help to ensure that almost 70 to 80% of those secrets that we talked about, right? So almost 6 to 7 secrets that we talked about in our presentation are already followed when you are focusing on these 50 companies, right? That's why if you are a first time investor, or even if you are an experienced investor, it makes sense to focus on these companies, okay? And the thing is that in markets such as the ones we see now, these companies can be available at very attractive prices, okay? So that's why it's important to focus on Nifty 50 companies. I'll quickly tell you what this space helps you to do. This page, as I told you, gives you a one-shot view of all the 50 companies. It helps you to understand again the 3 most important questions. Is it the right stock? Is it available at the right price? And is it the right time? Okay. So as I can see, ACC is very good currently in the hold zone. Okay. Timing signal is wait. So in one shot, I can get a view for all the Nifty 50 companies and I can take my decision. Okay. What's more is I can sort these companies. Okay. So if I want to find out just the green companies available at a 0 to 25 and 25 to 50% discount, and for which buy signals have been generated, I can just sort them, okay, and I immediately have a list of 3 companies. Okay, so just I think you must be noticing how easy it is for me to come from a universe of whatever 3000 companies to a list of 50, and following that up with a list of just 3 of the best companies that I can invest in right now. Okay, so 3 very good investment opportunities that you have in the current market. Okay, so the Nifty 50 product will ensure that you focus on the safest of companies and get such attractive investment opportunities. Okay, so that is the Nifty 50 product. I'll quickly tell you our subscription plans. So we basically have 4 subscription plans. Investor Pro 100, where you get access to 100 stocks for 1 year. Okay, so here you can get the right investment decision for any 100 stocks of your choice. Okay, so any company that you have in your mind, you can check the decision maker for any 100 companies. Moneyworks for Me filter you can use unlimited number of times. Okay, as you can see, it is unlimited access. Okay, 10-year X-ray, again you can view for 100 companies, price calculator for 100 companies, right? So any 100 companies of your choice, you can check it out completely n number of times in a year. Okay, and it is available for just rupees 4,950. Okay, one of our top selling plans. Investor 50 is the second plan that we have, wherein you can check the any 50 companies of your choice. Similarly, for investor 25, you can check any 25 companies of your choice. Okay, these plans are for rupees 3650 and rupees 1999 respectively. Okay, and lastly, we have the Nifty 50 Superstars. The difference here is that here you are focusing only on a predetermined list of 50 companies. Okay, because we are focusing on the Nifty 50 companies, it's a predetermined list, and you get access to the very simple and the very attractive user interface that I showed you some time back. Okay, that place wherein you can track all Nifty 50 companies in one place, you get access to that. Okay, so you can check out any Nifty 50 stock n number of times. Okay, and you get that all for just rupees 2999. Okay, and if you have any doubt of whether Nifty 50 stocks can give you good returns, I request you to please check out this space. Okay, a proof of how the best of Nifty 50 stocks can give you great returns. Because to be very honest with you, the first time that I saw this, I was so surprised and so angry at myself that why I didn't invest in Nifty 50 stocks. Okay, to quickly give you an example, consider Tata Motors. Okay, a Nifty 50 stock. This stock was quoting at rupees 146 somewhere around September October 2011. Okay, this was close to the discount price. In fact, it was below the discount price for Tata Motors, and within 6 months the stock went up to rupees 290. Okay, within 6 months, and that amounts to close to 100% returns within 6 months, and that too when I have invested in a safe stock like Tata Motors. Okay, it is one of the biggest companies in the country, relatively much safer than say some mid cap or some small cap stock. So what happens is we tend to overlook the power of these large companies, right? Because we get swayed by all these penny stocks, small cap stocks, right? All of these companies. So you can check out more such proofs for other Nifty stocks such as ICICI Bank, HDFC Bank, etc. Right? So do check this out. I think Nifty 50 Superstars is a product that all investors, be it a newbie investor or an experienced investor, needs to have in their portfolio. Right? A large chunk of your portfolio should be in such big, well-known, safe companies. Okay, so that was about our subscription products. I'm sure you would definitely like the different features and they'll prove to be very useful for you. So now that we have done with the site, I think we'll move on to the question answer session. So as we had mentioned in the start, you can put in your questions in the chat box. First question that we have is how to be wary of manipulators. Well, as I told you, manipulation, be it related to financials, is quite a difficult thing to assess. Reason being, a lot of subjectivity is involved. Also, many times, what the companies will do is they'll follow the law. I mean, these companies will follow the law, and law always has loopholes, right, which you can take advantage of, and companies tend to do that. I mean, any businessman will think from that perspective, as in find out the loophole and then try to profit from it. So it's quite difficult to assess. That is what we have been trying to do. I mean, our management assessment model is a sort of a step in that direction, wherein we are trying to find out different ways and different parameters to judge how trustworthy and reliable the management is, right? So I think the management assessment that I showed you, if I had to just show you once again. So management assessment which we have done, considering 5 important parameters, can give you a good indicator. But again, it's quite a lot of work. I mean, we still have to progress beyond the Nifty 50 companies. Reason being, it takes a lot of time to go through the annual reports, talk to the management, and then arrive at a rating, color code rating. So I think the management X-ray can help you. Going ahead, we'll be increasing the management rating for the other companies. So that will help you help you avoid such manipulative companies. Next question was, are there stocks from large caps, that is group A? Well, the Nifty 50 product is consists of the top 50 companies. So these are definitely the large cap or group A companies. Once again, just to reiterate myself, you need to focus on these companies because these are safest, some of the safest companies in the country, and they can give you good returns. Okay, but also what happens is some of these companies are not as good as the others, right? So something like BPCL, as you can see, the 10-year X-ray is red. So you also need to be a bit cautious. You need to find the safest of safe companies, and the Nifty 50 product can help you do that, right? So that's why I think the Nifty 50 product is a very useful product, because it helps me to find the safest of safe companies. Okay, so that is it. Another question that we have. Uh, Yeah, another question is that we have is if we use the Moneyworks filter, right? And we set up criteria whether the list of stocks that show up are large cap stocks or are they group A stocks. Well, what I'll tell you, what you can do is you can choose your category accordingly, right? So if you, what you can do is you can look at the indices, different indices. Now Nifty 50 and Sensex BSE 30 are large cap companies, okay, are group A companies. BSE 100 will also include quite a few large cap companies. So what you can do is you can choose your sort of criteria based on these. So if I want only large cap companies, I can say Nifty 50, I can say very good, I can look at 25 to 50% below MRP, or say 0 to 25% below MRP. Okay, I can search, and then you have say 11 companies from Nifty 50. So these are large cap or group A companies, and they are quoting at a 0 to 25% below MRP, 0 to 25% discount, right? So basically whatever criteria you want, you can set it accordingly. Okay, even if you select all companies, what you can do is you can check out these individual companies. So for example, if I check Dabur India, it's a large cap company. So once you go to the decision maker, you will get that information whether it's a large cap company or not. Okay, we'll take a couple of two more questions, because we have already basically gone beyond the scheduled time. So we'll take two more questions. Next question is you mentioned that large caps are pretty safe investments and penny stocks are not. What is your view on mid caps? Well, that is what I've been saying. You can, I think, a large portion of your portfolio should be focused on large cap companies. You can definitely move on to the mid cap companies, but obviously your allocation to these mid caps should be lower. Okay. Also try to ensure that you invest in the best of mid cap companies. Okay, so green companies which have something a sort of a moat or a competitive advantage, okay, which are quoting at a attractive discount price, and I think the margin of safety increases for mid cap companies, and that is actually something that we have done at Moneyworks. What we do is we look at a company specific discount rate. Okay, so you won't find a uniform discount rate across all companies. What we do is we look at individual company characteristics and then assign a discount rate for the companies. Okay, so that basically helps you get a more accurate sort of discount price for the individual companies. So you can definitely consider investing in mid caps, but I think you need to be very sure that it is a very good company and it is available at a very attractive price, right? So that is something that you need to be sure of. Okay, I think the next question is about allocation between large caps, mid caps, and small caps. What should I? What is the percentage that I should be investing in large caps, mid caps, and small caps? Well, basically this allocation depends on what is your risk profile. I mean, are you a person who does not want to take on more risk, or are you a person who loves to take on more risk? It also depends on your capacity to take on risk. I mean, what is your age? What is the income that you're earning? Right, what are your investment objectives, right? So it depends on a lot of things. To give you a sort of a answer to this question, In a few days we'll be launching a sort of a risk profiling feature, right? And I think that feature will be very very useful for you, because not only will it tell you what is your risk profile, I mean, are you sort of an aggressive investor, are you a risk averse investor, it will also tell you what is sort of the what is the allocation that you should follow. I mean, what percentage should you invest in large cap stocks, what percentage you should invest in mid cap, small cap stocks, etc. Okay, so I think just wait for a few days. I think it will be released in a week or two, and then you can take that, and I think you'll be able to find out that allocation more appropriately. Last question for the day is, when there is a strong buy or sell signal, should we buy or sell in lump sum or in piecemeal? Okay, so I think the question relates to, if there is a timing signal, should you go ahead and invest entirely or not? Well, I personally would not invest my entire planned amount in one go. I am a bit risk averse person, so I tend to be a bit cautious. So what I would do is, if there is a strong buy signal, I'll invest. First of all, I think you'll get a consider buy signal. So if there is a consider buy signal, I'll invest, say, 20 to 30% of my planned investment in a particular stock. When there is a strong buy signal following the consider buy, I'll invest more, say 30-40% of my planned investment. Okay, and going ahead, if the stock price starts going up, this is again I'm telling on a personal basis, I'll tend to again invest, say, the remaining 10 to 20% of my investment when I get that confidence that the stock is moving up. Okay, definitely you can go ahead and invest if the stock price falls as well, but you need to be sure about your analysis and you need to have that conviction, okay, over your analysis. So if you can do that, yeah, definitely you can go ahead and invest in one shot as well, but I would prefer to do it in a piecemeal sort of fashion. So I guess that's it for the day. We are already out of time, so we won't be able to take in more questions. What you can do is, you can mail in your questions to our customer care address. I think you can get the details on this slide. You can write in to us at customercare@moneyworksforme.com, or you can call us up at 02067210600. The number is on your screen. You can also visit our site moneyworksforme.com, and you will get a live chat feature, so you can chat with the customer care representatives who will be more than happy to help you out with any query that you may have. Lastly, I would ask you to sign up for a weekly newsletter, which is Stock Shastra. If you are a registered user, you'll already be getting this newsletter on a weekly basis. It will definitely help you learn more about investing in stocks the safest way. So do follow us, or do follow the weekly articles that we put up on our blog. You can also join us on Facebook and Twitter. Lastly, I would once again request you to keep on following the principles or the secrets that we discussed. I think instead of just focusing on multi-bagger returns, it is of prime importance that you focus that your capital is not eroded and that you get good decent returns. I think investing in safe stocks can fetch you close to 15% returns easily over a long term, right? So that's why 15% year on year returns easily over a long term. So that's why I think it's important to focus on safe stock investing. I showed you a lot of unique features that we have on our site which can help you to do that. So do check out our site, do check out the subscription plans. I'm sure you will find that the features that we have on our site can give you great value and can help you invest in stocks in the safest way. Okay, so it will make your stock investing experience considerably simple and help you get great returns. So that's it for the day. Once we end the webinar, you will be redirected to a short survey that we have for you. I request you to fill up that survey so that we can get feedback from you and improve the future webinars. We'll be conducting a lot of webinars in the future, so I request you to sign up for those webinars as well. You'll definitely get information regarding that in your mailbox. So that's it for today. Have a wonderful evening, and see you in our next webinars. Thank you.